Welcome to What's My Stock Worth training video. In this video, we will discuss the What My Stock's Worth investment strategy. We will do this by discussing three topics. 1. Methods to estimate true value. 2. Company performance. 3. Technical analysis or price movements. True value is the hypothetical real value of a company. The concept is that the price you see is not the actual value of the stock. Therefore, a calculation of the true value is done to determine how much the stock is really worth. If the true value is higher than what the stock is quoted at, it is considered undervalued or selling at a discount. In such a case, the What's My Stock Worth strategy summary item is listed as pass. It is recommended that a stock should not be purchased unless all the criteria are listed at pass in the What's My Stock Worth strategy calculator. Please note that the net book value criteria is optional in the calculator and the strategy summary. To demonstrate what we just discussed, what you see here is the strategy summary tab from the investment calculator. And as you can see, each of the categories are listed here. They have the value based on net income, value based on historical price to earnings, value based on discounted operating cash flows per share, and the value based on net book value. For the strategy to be passed, everything has to be listed as pass. The lone exception is net book value, and the reason being is net book value doesn't really factor in a lot of intangible items, so things that monetarily you can't see. So that is listed as an optional item. So these are the measurements that are used to measure the true value of a company. The What's My Stock Worth strategy calculates this estimated true value using several methods. First is discounted net income. This is estimated future earnings per share. So this is calculated by estimating future earnings per share, so over the next 20 years, using a provided growth rate, and then discounting those earnings to today's dollars using an interest rate, which is the return on investments. The second tool used is price to earnings value. This is done by comparing the current price to earnings ratio to a historical 3-year average for the company. Fourth is the operating cash flows discounted to today's value. What this does is discounting operating cash flows is calculated by estimating future operating cash flows per share, so for the next 20 years using a provided growth rate, and then discounting those cash flows to today's dollars using the interest rate, so the return on investment. And the final option is the net book value per share. Net book value is determined by taking the company's total assets less its total liabilities to get its net book value. This is then divided by the number of shares outstanding. Now, we've discussed these concepts pretty briefly, but there are videos created for each of these topics. So I'd recommend watching those videos to get a better understanding of each of how these are calculated and where the numbers come from. Now we will talk about company performance. One thing you should always consider that not all companies are created equal. There's some companies that perform very well and some perform average. The What's My Stock's Worth strategy incorporates the examination of financial performance indicators and also the review of company competitive advantages. Financial performance indicators show how well the company performs. The two indicators used in the strategy are return on equity and operating margin. Return on equity indicates the net profit per dollar invested in the company by the common shareholders. Return on equity of 13% means the firm is generating a 13-cent return per dollar of equity or net worth. The average return on equity is generally in the range of 11 to 13%. As such, the hurdle used in this strategy is 14%. Next, we'll talk about the operating margin. Operating margin is a crucial gauge of how efficient a company is at monitoring the costs and expenses associated with its normal business operations. In addition, it indicates how much pricing power the company has. Operating margin is conveyed as a percentage to gauge the percentage of revenue the company produces, which it can use to pay taxes and investors. For investors, the operating margin can be beneficial for equating companies. The higher the operating margin, obviously, the better. The hurdle used in the strategy is 27%. Any organization with an operating margin of 27% or higher is performing very well. When looking at operating margin, you need to consider that this also indicates if what the company is selling is a commodity, meaning there's a lot of steep competition and there's not much pricing power, or whether the organization has some competitive advantages and is able to get better prices on its goods. So the operating margin often is a numeric indicator of competitive advantages. Now we'll talk about competitive advantages. Competitive advantages are advantages that a company has over its competitions. Permitting the company to produce large sales or margins and keep additional customers. Some examples of competitive advantages include the company's cost structure, distribution network, and customer support. The more maintainable the competitive advantage, the more challenging it is for the competition to eliminate the advantage. There are two central kinds of competitive advantages, costing advantage and differentiating advantage. So a costing advantage is the company's capability to create goods or services at a lower cost than its competition. This enabling it to sell its goods or service at a cheaper price than its competitors can, or to produce a larger margin on revenue. Differentiating advantage is formed when a company's products or services vary from its competition and clients believe them to be better than the competition's products. The What's My Stock Worth strategy requires that these competitive advantages be documented. There is quite a bit of benefit in documenting and analyzing what these advantages are before purchasing a stock. In Do's and Don'ts video, we talk about doing your homework. In this calculator, it seems kind of brief how much we're discussing competitive advantages, but there really should be a lot of homework done behind the scenes to really understand what these advantages are and why the company you are looking to buy has an advantage over its competition. Now we will talk about technical analysis or price movement, so changes in prices. The What's My Worth strategy does not incorporate a lot of technical analysis. There's only one technical analysis tool we use. So one of the most common sayings on Wall Street is never try to catch a falling knife. While the What's My Stock Worth strategy mainly focuses on fundamental analysis, the one technical tool used is the 200-day moving average. Just for clarification, of fundamental stock analysis encompasses evaluating a company's financial statements, management, competitive advantages, and competitors when evaluating stocks as an investment. So fundamental analysis is basically not looking at the change in stock price. It's really just looking to the core of the company and how the company is performing, and not analyzing the changes in stock prices. Technical analysis, as a definition, is a technique of evaluating stock dependent on the idea that stock market information, for example, graphs of price, volume, and open interest, can help in forecasting future stock price tendencies. So unlike fundamental analysis, the true value of the stock is not involved. Technical analysts assume that the stock market can correctly forecast future prices of a stock by observing historical prices and other stock fluctuation variables. The idea behind technicians is basically that you can, by looking at graphs, you can come up with an idea what the mass or the herd is going to do. What's my stock worth strategy recommends to purchase only stocks trading above the 200-day moving average. So this is the lone technical tool we use. Um, yeah, it is very difficult to pick stocks at the bottom. So a stock may be trading downward because of mass psychology or information asymmetry, meaning some people have more information than you. Um, as such, we've included this requirement um, to avoid picking stocks that are trending downward. So yeah, you don't want to catch a falling knife. Uh, once you've gone to the calculator and you've updated the data entry tab, um, the calculator displays the status of these requirements. So it's recommended not to purchase stock unless all of these are in a pass state. The lone exception, as we mentioned before, is net book value. So we want, in this situation, so in this, uh, we would consider purchasing it, the stock. Um, we wouldn't because it's not above its 200-day moving average, even though discounted net income and historical PE, um, discounted operating cash flow is all pure good. But we're probably okay with a net book value because that's optional. But return on equity and profit margins seem good. But because it's below its 200-day moving average, we would not recommend purchasing this stock. So this is kind of a summary way that the calculator shows you where the strategy stands. So everything should be in a pass state with the lone exception of net book value.